bank. I often remind people that it's not Vanguard's capital or Fidelity's capital or BlackRock's capital. It's the savings and investments of millions of individuals and families, many of whom are investing through 401k retirement plans and 529 education savings plans and IRAs. The market is people with long-term goals investing through increasingly long-term investment vehicles. Now that I've retired from my leadership roles at Vanguard, I've had the chance to serve on the boards of a few public companies, and the experience has given me a better appreciation of the view from both sides of the table. One of my early learnings as a public company director was the importance of understanding the investor base, parsing out the kinds of investors who own the stock and why. Investors can hold the shares of a company for a matter of milliseconds, hours, days, months, or even decades. Some investors will make their perspectives known to you. Others you may never know they were there. But no one cares about the long-term health of a company as much as its permanent investors. At Vanguard, we realized that public companies did not fully appreciate the voice of the long-term investor. The investment infrastructure of the public markets is built on the rhythms of daily stock movements, quarterly reporting cycles, and annual meetings. Index funds don't necessarily participate in that conversation. They are more concerned with long-term governance and board oversight. At the beginning of this century, firms like Vanguard were known as passive index funds. No one really took governance as seriously as they should, except for early activists. They were beginning to have an undue influence on companies in which they had a far smaller position than ours. And the changes they were pushing were not always in the long-term interest of the company. That state of affairs led to an awakening at Vanguard and our peers when we stepped back and said, wait a minute. We are significant long-term holders, if not permanent ones, in some of these companies. And the activists are taking actions that might hurt long-term value for our shareholders. It was time for us to rethink our relationship with the companies in which our shareholders invested through our funds. Vanguard has always been maniacally focused on its shareholders. If you're an investor there, you're an owner. Index fund managers can't sell the stock of companies they don't like. The only way for an index fund to influence companies is through governance practices. We wanted boards at all companies to be engaged with their owners in the same way we are with ours. That's how Vanguard decided to become more active and more engaged. One of the crystallizing moments for Vanguard came in 2002, in the wake of the corporate governance failures at Enron, WorldCom, Adelphia, and others. Jack Brennan, by then Vanguard's CEO, wrote to the leaders of 450 companies in which Vanguard funds had substantial equity ownership. His letter laid out Vanguard's expectations on governance matters, such as board composition, executive compensation, auditor independence, and shareholder rights. Those corporate scandals and the reforms that followed, such as the Sarbanes-Oxley Act of 2002 and the tightening of listing requirements on major stock exchanges, spurred new levels of attention to governance in boardrooms worldwide. But much work was still necessary to build mutual understanding between public companies and their longest-term shareholders. A number of industry organizations and academic institutions helped to build a bridge. Columbia, Drexel, Harvard, and the University of Delaware regularly hosted forums where large, long-term investors, corporate directors, and management teams came together to discuss issues such as the board's role in risk oversight,